Tom Lee believes the market is heading into a correction, but he's confident it will eventually reach new all-time highs, and Morgan Stanley seem to also share this view. Now, in fact, when we look at the S&P year to date, many stocks have been soaring very high, but the reality is ultimately most of them are severely overvalued, and we're talking across many different metrics. So today we're shifting our focus. We're looking at beaten down stocks that are trading either near their 52-week lows or have been battered. We're talking double digit, and these are ones that are yet to reach their all-time highs. Underappreciated opportunities, real upside potential, and stocks that still could explode as the market does move forward. Now we're going to get straight into it with stock number one, which is Novo Nordisk. Now their latest earnings was a little bit of a disappointment if you want to compare it against analyst forecasts, and this is one that just continues to get beaten down month after month. It's in one of their largest drawdowns in history. And to make things worse, they did not that long ago cut their guidance. So we can see their sales got reduced to 8 to 14% for the full year when we saw it earlier on estimated to be a lot higher, and that also affects the free cash flow, which, as I'm sure you're aware by now, does ultimately impact our fair value. And we can see this guidance cut really hammered the company. We're talking 30% just on the back of this, whilst the company also slid in that they changed their CEO. But we did also see them climb up a little bit from their 52-week low, and that is with the ongoing issues they're having with copycats selling similar products at a much cheaper price. And we actually heard not that long ago from Eli Lilly, which was good news for Novo Nordisk, because their weight loss pill that analysts were expecting to see a large amount in weight loss actually came in under Novo Nordisk Wegovy injection, which did help give a bit of a gain to the share price. And to make things a little bit more bullish in this more recent period for investors is that the FDA have approved Wegovy for liver disease, and this is something we do expect will really help push them off the large drawdown that we just highlighted, because they're also not going through the greatest period. We've seen Ozempic decline in the 2 previous quarters, whilst in fact the alternative Eli Lilly's Wegovy increase and at a much more significant rate, around 289% versus NVO's 44%. And we can note they have been battered 58% in the last year, year to date down around 34%, and over the last 10 years they've now underperformed the S&P whilst being up 105%, and we can see all-time highs around a year ago above $140. Trading very near to 52-week lows, we can see the 52-week high probably seems like such a long time ago at $140, where Seeking Alpha are the only analyst rating here to give this a buy, respectable 4.08 out of 5. And if we look at a forward valuation of 14, that is well below their 5-year of 30, so straight off the bat we would say a severely undervalued signal. Remember though, we never look at any of these models in isolation. We're going to run through our DCF process shortly. With the yield above 3%, again another undervaluation point given historically it's been at 1.4, and given the disparity in the yield versus the historic, we will flag dividend safety of 90, very safe, is great to see, and reconfirming the severe undervaluation when looking at the blue tunnel, which as always in the parameters highlights a fair value. Massive disparity, one that's only gotten larger from the beginning of the year, and maybe you're surprised to see that when we zoom out the last 5 years, this one has been a company that more often than not has been trading severely overvalued. In fact, we only got to see undervaluation in 2025, and it also looks undervalued when we look at other valuation metrics. For example, the EV to EBIT, it's sitting pretty much at a decade low, and the growth unfortunately does get the D-. Yes, revenue last year was good at 21%. This year, whilst it has 17, expected to be slightly lower, and that is above the sector, which in comparison in single digits, but the thing that lets them down is the earnings per share projected to be much lower than initially anticipated, 7.5% over the next 3 to 5, when sector sits higher at 11 and their own 5-year does so at 15. Now institutions with their 12% ownership, and we will run through what they're doing for each of these stocks, they sold just under $6 billion in the last year. Now, they bought a little bit more in the same time frame at 7 billion, but they've also bought more in the most recent quarter. They've been buying the dip and they are net buyers, although worth flagging, in the previous quarter we actually saw the opposite trend. So something to note, but as always we never buy or sell based on what they're doing, just one layer of our investment thesis. Now our valuation comes to $52, which straight away you're probably thinking that is way too low, or why is this included? But we have two scenarios, another one where the intrinsic price comes to $82. So let's first talk about the first one that is at 52. Now this one has come from a DCF model, and ultimately we have the free cash flow year on year. It's grown 10% on average, but the thing that makes this model different from the previous is that we have used their updated guidance, and that is why the future free cash flow that you spot here will be a lot lower than the next one. Now, investors that use this model, probably those that see issues with Novo Nordisk over the longer term, and we have three different growth rates: low, medium and high, 12, 14, 16. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for NVO or any others, but we use the growth rate with the discount rate to give us the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to give us 52. So if you believe this is correct and this scenario, then downside of 9, and for full transparency, at 12%, 46, downside of 19, and for those a lot more optimistic on this scenario, 16%, intrinsically 59. This also flags that based on a reverse DCF model, 15% of growth is already what you're paying for today. So if you see that as way too high, then already overvalued, and vice versa. Now, as always, we take through the middle rate of 14%, which highlights you're not getting a margin of safety. In fact, you're paying a 9% premium. If you want a margin of safety of 10%, which we typically would use, execute on if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data, it would be a buy at 47, at 20%, a buy at 42, and at 25, 39. So 9% premium based on this scenario. Wall Street, their price target will be unchanged on either. They see 75 into next year, which translates to 32%. Now the next scenario at $82, we've used the starting point as their initial future free cash flow estimate, and this is for those that see this 1 year as just being a bump in the long-term road. And you can note at 14%, we've kept the growth rates the same, 44% upside. What this means then, baked in today is around 8.3%, regardless which one you use, 12, 14, 16, we are talking about upside. It's also more in tune with where Wall Street see this over the long term, and means you're getting a 31% margin of safety. You may prefer this model, believe it is most reasonable, but want a lower growth rate at 12%, then ultimately this means there is still a margin of safety sitting around 21%. Let us know, Novo Nordisk, in your view, stock number one, is it a buy, hold or avoid? Before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 29 stocks that Wall Street believe right now have the most upside in the S&P. So click below, you can sign up and read straight away. The next stock we're moving on to is the Trade Desk, where they released their earnings. We're talking just a few weeks ago. Earnings per share in line, revenue a marginal beat, and recently the advertising giant did in fact get a downgrade, and this is something investors need to consider, the longevity of the company. Having said that though, their revenue has been climbing at a very impressive rate from the back end of 2015, around 39% year on year, although we can see a bit of a slowdown in the more recent period. Now they've been battered 48% in the last 12 months, year to date 55, meaning they've lost more than half of their market cap in 2025 alone. trading very near to 52-week low, huge way away from all-time highs at $142, with a double buy from Seeking Alpha in Wall Street and a forward valuation now just below 30. And we had an article not that long ago from the Forbes discussing whether or not this is now a buy at $65, and they see all of this as a bit too much in terms of the reaction. Now we can see there is a slight miss on their Q3 guidance, which ultimately did lead to the large drop. We also have a departure, and when it is unforeseen, that also makes investors a little bit concerned by the CFO. And Forbes say that TDD presents an attractive investment at current pricing and something all investors should consider, again, if they do like the company. Now, a very quick look at their underlying metrics. Free cash flow has been pretty much consistently increasing from around 2021, expected to continue over the next year. And for growth companies, the question is always, how long can they sustain it at a very high rate? Yes, it has started to decrease, but we're talking in the mid-20s over the last few years, 23% on a trailing 12-month basis, and revenue continues to climb. Worth highlighting though, it's not a company that does share buybacks. If anything, they do dilute your position over the longer term, and ROIC sitting around the minimum 10% that we ideally want to know. Remember, we use that just to give us faith management are able to effectively allocate their capital. Margins decreasing, not something we want to see, but actually we noticed the reversal in 2022 onwards where it has started to climb up. Free cash flow, very impressive, at least from 2020, high double-digit numbers. And net debt to EBITDA, this is really what we want to see. 0 across the board from 2016, expected over the next year, highlighting it won't take TDD more than 1 day to pay off all of their debt net of cash on hand, correlating to balance sheet strength, so this is a good sign. Now their growth coming in at an A-, we see year on year 23%, expected 20 this year, well above the sector, low single digit, but ultimately growing slower than they have done historically, which we did just show. And earnings per share projected 20% growth, that is above the sector, but again slower than historicals where it sits around 29. Now valuation, yes, it does sit at a D-. One thing though we did want to flag here, on a price to earnings growth, it's sitting around 1 on a trailing 12 month, but actually forward looking around 1.46, which is a good sign. Remember, we've highlighted this in earlier episodes. Around 1 does look like an incredible opportunity. Ideally, you don't want to see it above 2, and that is where we're noticing it now. 1.46, pretty much in line with the sector, but they're growing much faster and lower than their own 5-year at 2.8. Now, institutions with their 68% ownership setting $4.5 billion, they've bought nearly twice as much, and actually they've bought more than 3 times as much in Q2. Maybe we see them continue to buy this very, very large dip. So overall, they are more bullish than in fact bearish. Now our intrinsic value, $65, again derived from the DCF model, highlights we've used a growth rate of 16%, which is pretty much the growth from last year, but we notice it is in fact lower than the previous. Now baked in already is 13%. Using 16 though, we get upside of 23. Worth flagging though, if you do believe it should be lower, well, something like 12% would be around $50 mark, indicating downside of 6. So using the 16% mark, then you do ultimately get a margin of safety sitting around 18%. If you wanted around 25, well, it would be around the $49 mark. Wall Street themselves incredibly bullish. They believe now is the time to take, in fact, advantage of the dip. They see this $78 into next year. We're talking 47% upside. TDD, let us know stock number 2. Buy, hold, or avoid. We then move on to Fortinet, in line on the revenue, most recent earnings, marginal beat on the earnings per share, and we got to see nice double-digit growth across many metrics. And similar to what we saw from TDD, we have Forbes believing this is one investors should buy very rapidly, although it has recovered from that drop around $70, now sitting around 80, and we can see something very similar from TDD. Their company's third quarter revenue guidance was marginally, and we're talking marginally lower than what was expected, and similar to the trade desk, we can note Forbes believe the sell-off does look to be fairly excessive. Now over the last month, it is down around 25%, so a quarter of their market cap wiped out in just a number of days. Year to date, down 15. Over the last 10 though, this one, massive outperformance of the S&P, trading very near 52-week lows, although we get one buy rating from Seeking Alpha, and we note here in fact a valuation forward P below 32. Now whilst they do get a D+ on the valuation grading, we can see on a trailing 12 month, the price to earnings growth 0.66, so looking very strong, but actually if we're looking on a forward basis, it does come slightly higher than we would like at 2.3, Worth noting though, historically it's sat near the 3 mark. And growth, whilst it does come in at a D+, last year they grew 15% top line, expected this year around 13, which whilst it is above the sector, a trend we're seeing quite a lot, they're actually anticipated to grow slower than they have done over the last 5 years. Now earnings per share, a little bit of a different story, coming in 14% projected, which is marginally below sector, but also below their own 5-year. With institutions and their 84% ownership selling 7 billion shares, they bought around 50% more, but they bought more than twice as much in Q2, really highlighting institutions continue to be very bullish on Fortinet. And our intrinsic value, $118, is derived using a growth rate of 15%. In fact, baked in right now is 9.3, so even if you see it at the lower end of 10%, there is upside, although a lot more marginal. If you believe we're being too conservative, well at 20%, 164, we're talking more than a double, but using the middle rate of 15, you are getting a large margin of safety of 32%. Wall Street have this bang on around $100 into the next year, 25% upside. Give us your views on Fortinet. We then see Okta, where they reported a double beat in their most recent earnings. We can see they've also recently turned net income positive, whilst also showing growth in their RPO. Now they're down 5% over the last year, trading towards the lower end of the 52-week range. We get a triple buy right across the board, not something we've seen recently, and we can note here a forward valuation 28 sitting just below Fortinet. And actually when we look at the valuation grading, they are also trading lower on a PG, 1.4, and that is below the sector 1.9, so you're getting a 26% discount, where their growth coming in at a B+, 14% last year, 12% this year expected, above the sector, but actually growing quite some way slower than they have done historically. When we look at the EPS projected, looking decent, 20%, above the sector at 15, but similar to revenue, slower than the historical of 33. And institutions with their 87% ownership selling 2 billion, they bought more than twice as much in the last year. They've bought, in fact, again around twice as much in Q2, something we saw in Q1 and Q4 2024, so they continue to be very bullish. In our intrinsic value at $136 is derived using a growth rate of 8%, and we note baked into the numbers as of today is 2.2, so lots of upside even if you see it at a lower rate of 4%, 12% we're talking nearly double, and in fact when we look at the margin of safety, very large, 32-33%. Wall Street also see nice upside, 122 into next year, 33%. Let us know your views on Okta, maybe you prefer Fortinet or maybe you just don't like the industry as a whole. We then move on to Hermes, which is in fact flat over the last year. Year to date, they're up only 3%. Over the last 6 months though, they are down around 15, trading towards the lower end of the 52-week range, where Seeking Alpha do give this a buy, and they also pay a yield, although fairly trivial, around the 1% point. Also worth flagging, this does come under a ticker symbol, so it is at a lower value for those that like to buy whole shares. And we can note, in fact, on this ticker symbol, we get a very, very rare 5 out of 5 strong buy rating from Wall Street. And it's also one where we saw the opposite to the industry overall. In the most recent quarter, there was growth, 15%, on their largest income segment, which is leather goods and saddlery, and we also saw growth pretty much across every other sector, bar watches and perfume. And it's also one company that stands out given the resale market is very hot. We're talking items at very high prices, they do typically retain their value. And for those that maybe prefer LVMH, well, when you just compare the two, in fact Hermes is head and shoulders above. We can see LVMH continuing to decrease quarter on quarter, and whilst we do get some patches of a decrease for Hermes, they're still producing, at least over the more recent period, double-digit growth, and their metrics also look very strong. Free cash flow continuing to grow over the longer term, sales growth at double-digit at least in the last few years, and shares outstanding, no movement. Total sales though, we're talking 3 times growth in the last 10 years. Return on invested capital, double digit, very consistent year on year, and no issues whatsoever on the margins, operating, showing efficiencies, growing over the long term, free cash flow consistently very, very high, and net debt to EBITDA, you could not get a better picture, 0 across the board, won't even take them one day to pay off all of their debt, net of cash on hand. And our intrinsic value, $2,714, is using a 20% growth rate, baked in already, fairly high, 18.4, so just something to consider whether you believe maybe this is one more for the watch list. Wall Street, they're a lot more bullish, they see a lot more growth, their price target, $3,000, well above our intrinsic value, they see 23% upside into next year. But if you wanted this at a higher MOS, at 20% buy at 2171, and at 25 around the $2,000 mark. Hermes, give us your views, or maybe you do prefer LVMH. It is in fact growing slower but also valued cheaper. And then we move on to ServiceNow, down 17% year to date. Over the last 10 years though, significant outperformance, up more than 1000%, trading towards the lower end of the 52-week range. Just one buy rating, that is from Wall Street, and in fact it is a strong buy, where the valuation, whilst we get a D- on a price to earnings growth moving forwards, 1.55, looking attractive, that is below both sector and their own historical, and growth looking good, B+, 21% last year, 21% expected this year, above the sector, but again very similar story to others today, growing slower than their historicals. Earnings per share looking very strong, 34% projected, well above the sector 15, but also marginally higher than their own 5-year of 33. And their RPO also growing very attractively year on year, 26%, with their revenue going back from 2015 growing at a 30% CAGR. Now institutional ownership sitting at 87%, we see 19 billion worth of sales in the last year, twice as much buying at 41, we're talking nearly 3 times as much buying in Q2, and if you want to see the reverse of the trend where institutions were selling more, you have to go back to Q1 2023. Clear and obvious, institutions do love ServiceNow. And our intrinsic price at $1,091 is using a growth rate of 20%, where we see baked in just under 17. If you want a lower rate at 15, then in fact you would know downside, and based on this, you're getting a 19% margin of safety. If you want a 25, well, a buy at around 818. Wall Street themselves see this 1155 in the next year, 30% upside. Could be a good opportunity if you want a growth stock at a reasonable price, but do let us know your views. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.